Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. This one may take some time, I'm afraid. Now, firstly, I want to set out the market's overall picture. And the reason for this, why it may take some time, is there's no simple solution here for what is a very complex problem. The bear channel, currently 513 to 577, for the February to June action, which is highlighted on my daily chart in bright red, had been the most significant pattern here this year. Now, 6 weeks ago, the market broke up through the upper bear channel line and confirmed the break higher by the end of that week. It did this by closing over a number of important resistances, notably the 50% absolute Fibonacci line at 682. The move up over the 50% absolute Fibonacci line was intrinsically important, but it was also important in another sense, as it was the gateway to the congestion band from March and April between 682 to 721, within which sit the January 2021 high at 693, the old October 2013 high at 721. Now, 4 weeks ago, prices followed on even higher by utilizing the medium moving average, currently 673, as a base for an attempt up into another congestion band, dating from December last year through to February this year, between about the March 2014 high at 725 up to the lesser Fibonacci line at 799, and containing within it the January 2022 low at 739 and the May 2014 high at 744. The market made it up into this congestion band, pushing up over the March 2014 high and even over the one piece of resistance coming down at that time that any market will usually have trouble in overcoming, and that's the slowly declining long moving average, currently at 730. Prices punched through the long moving average on 2 separate occasions in June, but did not close over it. Okay, so this is where I reprise my discussion point from 4 weeks ago, not only to discuss it as a point, but later on to bring it into this week's action. Okay, so I said 3 weeks ago, and I quote, "Whether I have named a specific level as one of the most stunningly accurate pieces of technical analysis I've done in a while, or else someone was taking the mickey. You see, for a few weeks now, I have been talking here about the bear channel highlighted in bright red that I mentioned earlier. Last week, so that is now 4 weeks ago, last week I even finessed the point further by specifically highlighting a topside target. This is what I said, and I quote, "Thus a primary target X would be in the 770 area, only a little above where we have reached, but the secondary target X1 will be a lot higher, up in the 855 area. And there is quite some congestion overhead and one important downtrend, the March 22 to date downtrend, that's currently at 815. This is the one based on the ultimate high of this market, but we'll have to see if the market can achieve target X first." End of quote. Well, as you can see on the daily chart, the high in late June after this original commentary was in the 770 area, specifically at 770 and a quarter. This was target X reached, and the market immediately turned and fell away. I do not believe that to have been a coincidence. I suspect it was another technical analyst who also came to the same conclusion I did and acted upon them, or it could just be the market taking the mickey. In whichever case, I was grateful to see target X achieved and then to see prices fall away, justifying it. Since then, the market when it fell away, back below all the previous resistances that became supports again, that have once again become resistances, it fell down to the significant neckline extension, currently at 649, of the small October 2020 to November 2020 head and shoulders top, which is highlighted in purple on my daily chart. This neckline has a fairly wide congestion area clustered around it, formed from late April to mid-July, between about 609 to 679. Now, this congestion lasted for about 2 weeks, supplying the market with enough ammunition before prices had another attempt higher last week and earlier this week. That rally from the neckline and also 3 out of the 4 moving averages moved all the way up to the 770X target area again, this time peaking at 769 before the phantom technical analyst out there, or Mickey Taker, take your pick, chose to cap it last week. However, this cap was not enough, and over the first 3 days of this week, prices tried again to push higher, making a new high not seen since February, and almost reaching the March 2022 to date downtrend. That's currently at 809. But turning back down again yesterday. Well, sorry, let me rephrase that. Wednesday. This move lower and the indecisive spinning top pattern on Tuesday have set up an interesting possibility of the first 3 days of this week possibly being a 3-day bearish evening star pattern. This is one to most definitely watch, as it ties in with some possibilities for longer term patterns. You see, 5 weeks ago I started a discussion on idea for the construction of a possible new quite large pattern. It is to look at the February to date and possibly even the October 22 to date action as a possible descending scallop pattern. This idea has seemingly moved along quite rapidly from its infancy. However, the move down and then up in July has provided some cognitive dissonance on this whole idea, both helping it and hindering it. I'll explain what I mean shortly, but first let me recap my ideas from 5 weeks ago, centered around the formation of this pattern. And I quote, "The first level to watch and see if it develops is right around where we are, the 708 area. The second, that will be higher around the mid-780s. More on this should it develop. I just wanted to give you a heads up just in case." End of quote. To this I added 4 weeks ago, and I quote, "Well, the 708 level did nothing. However, the 780 area, well, that exhibited potential last week, and this." So that is actually 5 weeks ago and 4 weeks ago. And it would also be for the potentially larger October 2022 to date action. Personally, I suspect if we haven't had the declining long moving average capping the market, this would have been a lot harder to see. That being said, we are close, but we still have some building to take place to form this pattern, and so many things can scupper this idea before it happens. And that's the end of the quote. Since then, the move up to the 770 area had finessed this topside watch level from 780 down to 770. However, having this recent Twin Peaks affair in the market has complicated the idea of a descending scallop pattern. It's not killed it off, just complicated it for me. Ideally, for a descending scallop pattern, the market needs to hesitate just the once to form a lip, if you will, which it did in late June. Again, ideally, after this hesitation and lip building, prices need to move in the direction of the ultimate pattern. Now, this move could have been both up and down, but it's important to note that a little over 3 out of 4 times the subsequent move is seen as down. That is what I thought we had started to see as we entered July. What was needed at the start of July to see the fulfillment of such a pattern construction, and please bear in mind this is just the completion of the construction of the pattern, not its outcome. So what was needed was to see if prices could come down to the base of the scallop. 4 weeks ago I suggested the July 2021 level low at 609. However, last week's low at 622 could suffice at a pinch. Last week's and the start of this week's move up has put a spanner in the works. Last week I held off judging this until I saw more action. I'm afraid this week I still do the same. The bigger picture is still obscured, and until it clears up I will not be able to start laying some potential targets in either direction. However, there has been some potential developments on the action since late May, and those are a possible late May, mid-July bullish Andrews and Schiff pitchforks. The Andrews is highlighted in dark blue and the Schiff is highlighted in bright green. Both have merit, though the bullish Schiff pitchfork seemingly has more credit, given the high intersects with the upper time currently at 797 this week. Before you ask, I am fully aware that such patterns counter the idea of a descending scallop pattern. But I think it important I should give you the whole picture, complex as it is, rather than just curated snapshots. Chicago corn. Back in early to mid-June, we saw a remarkable recovery that carried on into the third full week of June. Prices punched up through the old congestion at 548 to 556 and 561 to 567, like they were not even there, along with more recent congestion from early May between about 580 to 600. This congestion, as I said 6 weeks ago, and I quote, "Apart from being recent, it is also not that strong, and it would not be surprising to see a move higher towards the wide band of stratified congestion from February through to April between 610 to 640, end of quote. I further added at the time, and I quote, "Beyond that comes the first big significant longer term resistance, the 50% Fibonacci line of the September to May 2023 move at 655. In between any attempt there and where we are now, I hope we can see a new pattern emerge, perhaps a skeletal descending scallop pattern, but it's too early to see right now," end of quote. In addition to the congestions, the market also punched up through the short medium moving average, currently at 533, the medium moving average, currently 571, as well as the late February to date downtrend, currently at 587. All these, along with the 610 to 640 band, have slowed and eventually turned the market back down, without the need of relying on the capping action of the descending long moving average further up, and that's currently at 620. Now, the pullback lower at the end of June and into July has been similarly remarkable. The one key piece of market action I wanted to see happen I described 5 weeks ago thus, and I quote, "To see if we are forming a lip as part of the descending scallop pattern, and by lip I mean the following. In case the market chooses to try and form a descending scallop pattern, it would first need to hesitate, to form a lip if you will, and then after hesitating for a while, move in the direction of the ultimate pattern. This move can be both up and down, but it's important to note that a little over 3 out of 4 times the subsequent move would be lower. That is what is needed to see in case this market does intend to form a descending scallop pattern. I have to say, if it does try to do this, then it will be one ugly looking pattern," end of quote. Okay, so in early to middle July, we have seen the market hesitate and fall to even lower levels than back in May, and in the process form a lip. The question I left last time was, how far will this market need to fall to fully construct an ugly looking descending scallop pattern? I commented 4 weeks ago thus, and I quote, "At the moment the market is being held up by the combination of the 2014 high and the 61.8% absolute Fibonacci line at 525. This is not enough, nor is the October 2021 low at 516, nor the lesser Fibonacci line at 506. Only when we may see prices down within the congestion between 486 to 498 that contains the 2021 low at 498, only then can we start looking at this potential descending scallop as having been formed, and thereafter at potential targets below," end of quote. Well, prices did fall down to congestion between 486 to 498, but 2 weeks ago the market formed a pipe bottom and shot back up again, penetrating all the resistances, once again halting temporarily at the July 2013 high at 563.5 with a pipe top, before on Monday this week prices once again moved higher, though only as far as the descending medium moving average, currently at 571, before heading back down again below the congestion between 548 to 567, and interestingly below the recent 50% Fibonacci line at 549. Looking at this action, there is no way that this action since late June could be seen as a descending scallop pattern, no matter how much I optimize it. Once again, for a second week, I'm going to take a short step back and wait and see what new pattern will develop here. Even the monthly charts do not provide much of a clue other than this right now still looks like a monthly bullish engulfing pattern. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.